Support for the show comes from Capital.com. Capital.com is a global investment platform that aims to accelerate financial inclusion worldwide. For seasoned traders, Capital.com offers 24-hour support in more than 10 languages, as well as news, reports, and analysis to help you make informed decisions. If you are new to investing, then you should visit Capital.com's Education Hub, which has in-depth courses to help you get started. For more, check out Capital, that's Capital.com. Look, I was thinking about it yesterday because I was researching, obviously, to figure out how to get you to speak today. But
I'm a recurring guest. It's not hard to get me to speak.
Yeah, you are a recurring guest, exactly. Once a year, I think it will be, at the beginning of the year, I think it's a good pace. We wrap up the previous year, we talk about predictions. But yeah. I just wanted to say something because I don't think, everybody knows that don't worry, that the ecosystem owes so much to you, by the way. You were worried for a second, weren't you?
I wasn't sure which direction you were going in.
Hi everyone, and welcome to Conversations with Loulou. As we kick off 2024, I thought it would be great for us to understand what happened in 2023 on the startup investment landscape and also get some predictions about 2024 from the man himself, Philip Bahoshy, the founder and CEO of MAGNiTT, the region's leading startup investment platform. What's going to happen in 2024? Are we going to see a soft landing or a recession? Are we going to see more IPOs in Saudi? Are we going to see the venture investment rebound from this year, which was pretty low? A lot to be discussed as we unpacked his Emerging Venture Market 2023 report. So let's tune in. Philip, how are you?
Good, thank you.
Yeah?
Yeah.
All's good?
Keeping healthy.
Keeping healthy. How's the running? Speaking of keeping healthy.
Running's been going well, yeah.
Yeah?
I've been doing lots of running outside in the Business Bay area. I've been doing it at home.
The weather is beautiful, yeah. What's your pace now? Because you're pretty fast.
No, I now do 5 minutes per kilometer, something like that.
That's really fast. I do like 6.5.
Try to stay healthy.
So you do
doing HIIT workout,
so you do
running,
5K in what, like 25 minutes or so?
Yeah, more or less.
Nice.
But I do different things. I do incline run in the gym, walking. I have to do kind of 30 minutes every day. And now I work to the office. We moved our office to the IFC. We're just in front of Sheikh Nonna in the Innovation 1 building. 25-minute walk every day, morning and evening.
Nice.
To get to the office.
Like a true European now, huh? Walking.
Try. Well, you can, as long as you can here.
Yeah.
I mean, for so many times you can't. So if you can, then there's no reason you can't benefit from it.
What else are you doing?
At the moment, keeping busy with MAGNiTT and working hard.
Yeah.
Just enjoying that.
No, I don't know, because everyone seems to be into something. No retreats, no vegan,
personally, no. I'm doing dry January.
Dry January, yeah, me too.
There you go. So I've been doing dry January. I like dry January. It gives you clarity at the week. You binge all of Christmas. You enjoy the holiday. You enjoy whatever it is at the end of the year where it gets extremely exhausting. And then you do 1 month of just kind of reset and focus. And I'm obsessed. I'm a data junkie. I've got Whoops.
What is that? Whoop? Okay.
I've got the Whoop. I've got the Apple Watch. I've been tracking steps and recovery and all of that stuff. So I've just focused on dry Jan.
Okay, dry Jan. Basics. That's good. Yeah, me too.
Keep life simple.
Me too. Now, I honestly want to say, I think that the ecosystem owes so much to the work that you've done.
Thank you.
And so much to MAGNiTT because you sized the ecosystem. Like now we know, okay, it's not big, but now we know that, $2.2 billion were spent on startups, or we know like how many startups are in this industry or that industry. So it's all because of the hard work that you've put in.
Thank you.
So I maybe if you can take us back a little bit, I was curious to know, how did you get started? How did you do it? You were on your own. Yeah. You had no funding. And people here don't want to give data.
Yep. So at the beginning...
So what did you do? Like the first, 1,000 people on that database.
I'm grateful to the army of interns that I had because I was self-funded for the first 2 years. And I kept on alluring a bunch of interns who were young, ambitious, hungry, and I thank every single one of them. And it was very manual. We would go to every conference. We would get the business cards of all of the startups. We would go to all of the investors, all the accelerators, get their data. And if you can imagine, originally it was like an Excel spreadsheet of line data. We're now in a world of AI and ChatGPT and everything. At the time, it was manual entries of every single investment round. But I always thought, and I was complimented once by someone that said, look, what you've done is taken what VCs have access to, but you've just managed to put it into a schema that is very clear and organized. And that was the differentiating factor. Using my consulting background, my banking background, having worked at Oliver Wyman and kind of Barclays in a strategic view, it was really taking all of that information and gathering as much data as possible, and then ultimately simplifying it into the most basic charts that told a story.
Yeah.
I'm a big fan of a book called like Super Founders, and they talk about what are the traits of successful founders. Not to say that I'm a successful founder, but one of the
you
things
are a successful founder
that you identify is that consultants by nature are very structured and very good at storytelling. And hence, they're able to simplify when it comes to pitch decks and articulating stories and dreams into facts, data, and visuals. And effectively, we just applied that to the data, to the ecosystem. And I always remember the first 2-3 reports that we brought out. The first was the state of startups, which I piggybacked off the back of, the state of payments that was done by Payfor back in the day. I loved it. It came out. It was distributed by everyone. And it was this book which just basically broke down payments across the whole of the region. And I said, well, okay, I don't have the funds to be able to do that, but we can get Canva online and put a couple of charts because we have 2,500 companies on the platform. We have all of their funding information because we've been aggregating it. We've been speaking to all of these different people. So let's put out this PDF that was, I think, 3 pages long, which had probably 12 charts on it, four per page. And it's still on, you can find it. In fact, I posted it on LinkedIn, I think, recently. And people said, oh, okay, you have some data, which they didn't realize because we were positioning ourselves as this connection platform and everyone said we don't need this connection platform. And then following that, we said, well, people thought that was interesting. Why don't we do one around funding? And there weren't many people back in, I think it was 2016, the first one that we did, that were publishing data on the state of the ecosystem. 1 or 2 did, but not many. And we were like, but the numbers that are going out aren't necessarily accurate because we know the accurate numbers, but they seem to be different. So we started putting out the next one, which was the state of funding. One thing I've learned, and I always say this for anyone interested in startups, that content marketing is extremely powerful. The media is hungry for data. Trying to push a product, a feature, etc., it doesn't quite grab the interest of the media, but data is extremely interesting. So like a pro tip for any founder, literally whatever industry you're in, as a founder or in the marketing team, being able to use content marketing as a channel with insightful data. Think about what you read on a weekly, daily basis, the announcements that are done on real estate in the UAE, growth figures, the penetration of e-commerce that Bain does. People love that because people want to benchmark and understand what was happening.
Of course.
So that particular report became quite popular. And then we did 2 or 3 more. One was on exits, which nobody had quantified in the region. And then we did one, which I still think is my favorite, which we will be replicating in the coming weeks, is a founders report, which is in reference to the book that I just mentioned, Super Founders, where we benchmark the backgrounds and the demographics and the experience and the mindset, experience of founders in the region. So there was conversations I would have where people said, quit university, start a startup, forget about working. Who needs an MBA? Become an entrepreneur, give it a go. And while I encourage the ethos and the idea of it, the fallacy that every entrepreneur that's 21 that quits university like Zuckerberg did, and this was the time of the social network, is going to become the next unicorn, was flawed.
Yes, of course.
Because when you go back, and this was, I think, in 2016 when we published it, I think the majority, and I don't have the numbers immediately off the top of my head, the average age of the founder here in the region was 35. 30% of them had come from banking and consulting. Very few of them had previously worked at a startup, but those that did had come from Maktub and Souk and the other startups that were here in the region. And then you backward engineer it. They have a story, they have experience, they come from industry, they can story tell. So when we look at Kareem and the success of the two founders, who I've had the pleasure of getting to know relatively intimately, professionally, and interviewed Magnus at an event, deep diving, you realize he was a serial entrepreneur from the age of teens, where he'd started a robotics company or a platform company. He then was working at McKinsey. These guys are extremely well educated. They have huge amount of experience in the region. And Mudassir had done multiple startups. Yeah. You mentioned Eli that you've recently interviewed. Well. Exactly. Eli Habib from Anghabi. Yeah. He'd done multiple companies before they get to this company. And you begin to realize telling a 18, 19, 20-year-old quit, give it a go, try.
It's ridiculous.
But what does it take to become successful? It takes a huge amount of experience, real life, hard experiences to know what's working and what's not working. And hence, I believe Fadi always used to say it, serial entrepreneurs make the best, Fadi Khandour.
Yes.
Serial entrepreneurs make the best entrepreneurs. And you agree with that. There's a reason. Whether they succeed or fail, there's a huge amount of learning that they've had as part of the journey. That means that the next time of doing it, that an investor, if that's what you seek for, or just building a company, rallying a team, getting people on board, can actually understand, no, he's coming from a place of experience. It's not a first time of doing it. So back to the question, then we brought out that report. And really it was that transparency of data. And I thank you for your comment for supporting the ecosystem, but core to what our proposition was as we did that, and we eventually did what has only been our only fundraise back in 2018, was that we wanted to disrupt the information gathering that was existing in what was the venture capital space in the regional markets. We had heard and knew, and I followed, of PitchBook and CB Insights and Crunchbase, but the challenge was always that the depth of data, the depth of insights, the depth of information for the regions we covered was always very shallow. And we said, well, there's the opportunity. We're growing at a much faster rate. Things are developing. People are interested. Governments are interested. VCs are interested. But the information transparency was extremely thin. And that was what we tried to capitalize on at the time.
Yeah, I mean, I have so many follow-on questions to what you said.
Feel free to cut me off.
No, I didn't want to cut you off. Look, I think what is also amazing about what you're doing is that, you know, you've only done one funding round.
We did two. The first time it was when it was the Tinder model and it didn't really make sense and nobody kind of bought into that. When we pivoted toward the data side, data businesses have huge amount of value, but they're not exponential growth. When you look at some of the international players, take Crunchbase, they've raised more than $100 million. But they tried to disrupt the social network, from what I understand, of LinkedIn for startups. So the pitch was somewhat different, although the core proposition was ultimately data aggregation. In fact, when you look at some of the international players, many of whom or some of whom have been acquired, PitchBook by Morningstar, you see that in Southeast Asia, Deal Street Asia is acquired by the Nikkei group, that actually it doesn't take a huge amount of funding once you get to monetization. Then it's about what's the right business model. So MAGNiTT's evolved so many times over the years.
You run a profitable business today.
Yeah, profitable, breaking even, relatively lean, doing what we're doing. It's been a good business model up to date. But you do realize that you do need firepower. Like if you want to continue to grow, then that's different. But to date, it's been about being efficient. And in that journey, we've kind of tried to work out what's the right business model. So MAGNiTT, if you went back 5 years ago, for anyone that was using the platform, was a blog, news site, directory, which had a job board. You could apply to investors. And one of the really hard learning lessons is if you try to do everything. And we tried to replicate that Crunch-based LinkedIn model, which is what I liked because it would get as much engagement as possible, but it was very hard to monetize because which problem were you solving for? Are you solving for job boards? But there's many job boards. Were you solving for news? But it was a super competitive landscape for news and information. Were you solving for trying to help startups apply to investors? But then do you have a brokerage fee? And are you getting the right startups? And it was really a learning lesson of, okay, we're a data platform.
Yeah.
You have data. How can that teach you how to evolve? And the real learning lesson as to when that came into practice was COVID. So as with everyone else, extremely challenging environment. And as a data platform at the time that had perks, news, investors, etc., all of a sudden our advertisers stopped because they were like, well, right, we can't pay for advertising. We don't have events. There's no accelerator programs going on. We don't want to be pushing products. We have to cut our marketing spend. And we realized, okay, well, the sustainable part is subscriptions because people still need access to this information and data. And I credit our CTO, Dana, who's amazing. She said, right, very simple. Before we build any new feature, something else has to be killed. And if anyone wants to suggest a new feature, they have to justify why that's going to be better and what they want to replace it for. And in that 6 months, I always say it was kind of a weird thing to say, but a blessing in disguise. We really pivoted from what was this all-encompassing platform that tried to help everyone and support towards what is it that's really going to help us sustain ourselves and actually scale and grow. So in that journey, we then became an online subscription model that used to compete with like online purchases. And then at some point in the last 2 years, which is what I'm very happy with, we shifted towards becoming a pure enterprise, corporate, government client platform where we stripped out all of the elements that didn't provide us ROI or became a lot of distraction. We're a data platform. I keep repeating it to everyone on the team. At the core of what MAGNiTT is, we are a data platform. And I go back to that Excel spreadsheet. It's now automated, it's online, huge databases, everything's done, but it's a data platform from which we support our clients who are governments, corporate, big tech investors who pay a sizable amount to get access to MAGNiTT to make informed decisions. We fill the gap in VC to help them make the best decisions. So it's been a journey, but like from what was a connection platform, I think it's a long answer from what started MAGNiTT to where we are. It's just been a series of learning lessons along the way.
How do you see the appetite to share information? How did that change from, when you started till today? Are people more open to sharing data or is it still a struggle?
It's always going to be a struggle.
Okay.
I think that's sometimes what people forget. And it's difficult because it's easy to criticize, but it's very hard to do it. And so why does MAGNiTT exist? At its core, unlike international markets, albeit that they have the same challenges as we do, we don't have regulatory bodies that track venture capital investment. In fact, and you're very well aware of this from an investment perspective and from a startup, many investment rounds, you are encouraged to set up your holding company as BVI, Cayman, Delaware, Singapore, maybe ADGN, none of which are really easily accessible for data purposes to gather financial records, revenue records, secondaries, shareholder entitlements. If you speak with entities and the local regulators, they will have information, which is the operating company. But you can have an operating company based out of a free zone in Dubai, which has a share capital of $50,000 and has one managing director, but all of the investment information is done at the holding company. So ultimately, it's very difficult to get this information and data. And so we basically built this out as a proposition to aggregate data that we can get. When we started, nobody wanted to share this information. There was this closed-minded concept of, no, I don't want to share. And it was only when we started putting out the research that things began to change. And I'll never forget one of the conferences that was taking place here, STEP, would just released the end of year report. And people were saying, wow, great, this is amazing. We have transparency. Thank you. This is really useful. And I was like, sure. And we want to develop this and grow this. And there was an investor that I won't mention that was on stage that said, yeah, well, according to the MAGNiTT report, there's been, for the sake of argument, $1 billion invested in MENA, but we think that the number is incorrect. And we think it's more, and continued. And somebody sent me a message and said, well, that's what they've said on stage. And I remember saying, okay, well, I'll go and say hi to this person. So I saw them later and I went up and said hi and he said, oh, hi. And he knew who I was and what I was doing. He said, oh, thank you for doing what you're doing. And I said, can I just ask you a question? And he said, yeah, sure. And he said, why did you say on stage that our numbers are wrong? And he said, oh, well, yeah, no, well, I meant that your numbers are wrong. They're inaccurate. And I said, why? He says, well, you don't have our data. And I said, but did you say that on stage? And he goes, no. I was like, well, it would have been better if you said it's inaccurate because we have not provided them the data. But how are we meant to represent the data if we can't get access to it? We do the best representation of what is publicly available or through conversations that we're having with investors. If you would like to provide us that data, we can include it. But I prefer that you caveat it by saying why it's inaccurate rather than just assuming it's inaccurate.
Yeah.
And we always used to have, and we still do, an investor ranking table. And in that ranking table, it provides what was historically the total number of transactions. And then now we calculate the amount of capital that's being deployed. And from that, people said, okay, well, we actually need the numbers to be correctly represented because it's something that's important.
Because now there's like a leaderboard.
It's not a leaderboard. I hate like looking at it as a leaderboard, but it gives a benchmarking reference of people's activity. And so from that, people realized actually we have more to win and gain. If government entities are trying to understand what's happening in the ecosystem, if the press is using this as a tool to kind of shine the light on the venture space, if startups are trying to see who do we speak to, if LPs are trying to understand who the key players are, then why are we living in a vacuum in an opaque environment whereby we can actually represent correct data? So then slowly, people started sharing information because it was relevant and it was important. And that's kind of how part of the proposition was built up. There are always going to be people who are uncomfortable sharing that data. Okay? And it's by the way, no international player has necessarily more data because they're doing something different. They're all doing exactly the same thing. The only thing in the US, or take the UK, you have the company house. You can literally get an API into every company and each shareholding and every revenue thing. So then you're competing on product and insights and etc. But here, you don't have that level of information. And therefore, it's a win-win. The ecosystem wins by having greater transparency and visibility, and the people that are ultimately providing the information and data can get more support.
But in terms of context, I think you are in a position where you speak to a lot of important people. You're talking to sovereign wealth funds. You're sitting with governments. You're sitting with the top venture capitalists, with entrepreneurs, etc. So there's a lot of insights as well, context. Why don't you go into that as a platform?
Well, we do. I mean, we basically do it in our research. That's one of the things that we changed. Once we shifted towards being an enterprise model, it wasn't about, because you had to justify a 15, 20K subscription to the platform. A lot of the people that were asking us in terms of clients, they're like, what's the so what? What's the reason behind it? What happens behind it? So for any clients of ours that now download our end of year report, starting the middle of last year, I started really pushing the team that before we go into any data, start with the macro. What's happening macro globally, macro regionally? What happened in the venture capital ecosystem in the last 6 months leading up to the end of year report? Were there new funds that were released? Were there new government initiatives? Were there events that were taking place? What's happening with interest rates? And then you dive into the data, but it's, on
like the day to day, because you get a lot of press releases. I mean, you aggregate a lot of the okay, so and so raised this, so and so raised that, etc. But on that, like maybe not in your yearly report, but on the day to day.
Yeah, but so we do it with our clients. So with the clients who are clients of MAGNiTT, number one, I was giving the example of the research reports. But the second, we have these analyst hours. So you can get, as part of your subscription, access to a member of the research team who can run through the data and then answer questions. We don't always have our answers to every question, but if they're questions that make sense, we're not a consulting firm, but if they want to understand or have a particular view, how much investment came from outside of the region, because people have been obsessed that all these investors are coming from Silicon Valley. Have we seen more investment coming into the region from US-based investors than last year? Sure, give me 5 minutes, I'll get back to you. I'll get their answer for you. So that's one way of basically taking data, but actually answering questions and understanding that. But the reason I tell you the macro, the micro is if you don't put things in the context of what's happening globally, regionally, in the venture space, then it's kind of in isolation of just a number. It's easy to say Saudi Arabia went up 33% and the UAE went down 45%. Singapore is 3 times larger than Saudi, but without context, it's just numbers.
Yeah.
And that's what we're trying to continue to develop as part of the proposition for people that are interested in what we're doing. And it's definitely the part that I enjoy the most, which is why at its core, it's a data platform. But data is only really as useful as the insights that you pull out of the data. Otherwise, it's just a big Excel spreadsheet with lots of information and data points.
So how would you summarize 2023?
In terms of venture?
In terms of what happened? I mean, you just released the emerging venture market report.
Turbulent. I think
turbulent.
It's been a very turbulent year. I've mentioned a few times over the last couple of months that interest rates is the devil of venture capital. And what I mean by that is that venture interest rates, and I think I mentioned this on a previous podcast, which have now gone to close to 5.5, 6% in the US. And the world basically takes the lead of what's happening in the US Fed markets. In an attempt to curtail inflation, your opportunity cost of capital is just that much higher.
Yeah.
And that played out through the whole of last year. And so when your opportunity cost is that high, investors generally shift away from riskier bets where we experienced post-COVID 0 interest rates for 2 years, where literally everyone was funding anything that they could find access to. Because what's your alternative? You're not putting money into the bank. You're not getting treasuries. Your bonds are not attractive. So you might as well invest in something that has a payoff. Now you can go to a bank and get 5.2, 5.5, whatever it is that you can get % without doing anything. Then why invest in a risky
5.5,
startup?
I think I checked it today. That
the Fed rate is
5.5,
exactly.
No, the 3-month treasury bill. I think it was 5.3 or 5.
Exactly, 5.3
like for 3 months.
It is for 3 months. So you could do that without doing anything.
Yeah.
So why are you going and investing? The stock market, crazy story last year. I mean, having seen a big decline in 2022, 45% increase on the NASDAQ, 25% in the S&P. But the reality is, if you actually look at the chart, it was a turbulent roller coaster where it started the year with the AI boom, OpenAI. 7 stocks attributed 75% of the growth of both the S&P and the NASDAQ, being the tech stocks, Amazon, Apple, etc. The rest of the S&P and the NASDAQ basically attributed nothing. Then you saw in Q3 a slight rocky slowdown and things people were talking about being a hard landing, challenging, things are difficult. And then sentiment started picking up at the end of the year. And you saw this massive rally in the last 6 weeks of 2024. And Jerome Powell, the Fed chairman, comes out and says, I think the economic indicators are showing positive signs. US growth is looking somewhat more positive. There was a 3.4, I think, GDP figure for the end of year. We are anticipating potentially, and I'm paraphrasing, 3 rate cuts going into 2024 and a soft landing. Okay, great. People are all very positive. Let's start the year extremely good. And what does that mean for venture? Venture throughout the year isn't the public markets. And I'll come on to that in a second. But what happens in the first 2 weeks of this year? Well, inflation figures in the US were slightly higher than predicted. You have seen mass layoffs. Corporates like Citigroup, Google. There was a tweet that I shared in my webinar, which had 15 tech companies that each had laid off up to 25, 30% of their staff in the first 2 weeks. So you realize leading up to the end of year, things were becoming a bit more positive, and boom, beginning of these 2 weeks, things are getting difficult. You talk about the impact on oil price. So oil price is a little bit of a double-edged sword. Geopolitics in the region, which I don't necessarily want to get into now, but will create volatility in oil prices. Oil prices were at the high for the year at close to $95, $96 a barrel. In, I think it was August of last year. Then it went down to 56. Now, at the end of last year, it started going up again. What happens when oil prices go up? When geopolitics or uncertainty happens? It means the cost of everything, delivery, goods, etc., increases, which means inflationary pressure goes up. If inflationary pressure goes up, what's the Fed going to do? Maintain interest rates at higher rates. So where we were already predicting 3 rate cuts with potentially 1 rate cut coming in Q1, everyone is already saying, no, it's going to be higher for longer. And actually, maybe we'll have to wait until H2, etc.
Okay, so turbulent year 2023. You're sitting down with all the important people, a lot of the ecosystem players. What's the mood like for 2024?
I think going into 2024, there's a kind of cautious optimism or cautious positive sentiment.
Cautious optimism. Okay, so you're optimistic, but not so much.
I think people are still on the fence. I mean, ultimately, I think that last year, like I said, was a very challenging year. And again, it depends where you're speaking. I mean, Saudi Arabia and the UAE are definitely having strong growth off the back of the double-edged sword. So obviously when oil prices are high, then many of the sovereign entities
government
spending and they can fund. So if you look at the Saudi ecosystem, with the work that PIF is doing and then supporting entities like SVC, Sanabel, Jeddah Fund of Funds, they can help stimulate the economy where other they are stimulating economies where other geographies aren't able to do that because they're dealing with the real economy of what to do with inflationary pressure, devaluation of currencies, as we've seen in Egypt. You look at the Levant as an example, have their own geopolitical tensions that are happening from that perspective. So venture is not necessarily top on the agenda from that perspective.
There's no venture there happening, right?
There's very little venture
I saw you mentioned on a group where we're all part of, $28 million was spent in Jordan.
Correct.
On startups last year.
Yeah, I think
Lebanon, 2 million?
2 million. At least this is the data that you can find.
Okay.
Now, many of the startups that are in these locations have potentially relocated to the UAE and Saudi Arabia.
Oh, yes.
I mean, to a certain extent, when you're looking at market size and the opportunities and where the funding is, at this point, many companies are potentially moving to locations where they can get funding and market size.
Yeah.
So I think right now you're seeing the UAE and Saudi being able to buck, at least to a certain extent, the trend that you're seeing globally and regionally, albeit that they're not completely immune. I mean, everywhere you're seeing this impact. Ultimately,
but they're not immune. I mean, we saw with the exception of Saudi Arabia, which pumped a lot of money.
They're not immune. No, exactly.
Yeah.
So exactly.
Everyone else is down.
Everyone is kind of susceptible to what they're not immune to these things. You do see, even in Saudi's case, which saw 33% growth year on year, 64% attributed to some very spectacular mega deals, but the underlying ecosystem, when you strip that out, did see a decline. And the total number of transactions were down year on year. So when you look at funding as the bet you want to put into the venture space, and then the number of transactions is the appetite to invest on that, the global figures were 45% down year on year in terms of the bet.
Yeah.
And
$248 billion invested globally in VC as per CB Insights.
There you go. So, but that's down 45%
down,
year on year.
Yeah. The peak in 2021 was 648.
Exactly.
So
it
400 billion down.
But it's always, but again, as someone who looks at the data, why? When interest rates are where they are, and when investor appetite is where it is, what is the segment of the market that's going to collapse the most? Late stage investment. Because late stage investment is always done in a hope that you're going to IPO or exit.
Yeah.
Right? You're doing that bet for a 2x return in 2 years for a $200, $300 million investment, right? Not a first angel ticket for a 7-8 year journey for a multiple X exit on that investment.
Yeah.
You're doing big ticket, big bet, big return. Well, we've seen the lowest level of IPOs, transactions, and listings in the last year. If you look at M&As, which are extremely challenging, one of the bets that I didn't get right this year, thinking that there'd be more M&As. But why? An M&A transaction requires either financial, which is a private equity, which means that you need the capital and interest. In many cases, private equity driven by financial models that are sustainable. So you need a company that can show, for the sake of argument, $50 million of ARR and is unit economic, profitable, or at least breaking even. Well, how many of those tech companies that have been raising hundreds of millions of dollars are that? So private equity, yeah, I think we're getting to a sweet spot in the next couple of months or years for that. Strategic. Strategic requires corporate and or big tech company looking to acquire. Well, in a market where everyone's cutting, investment is low, and people are looking to rebalance their books, it takes quite a lot for a strategic investment to come into fruition. You need cash, emotive, strategic investor, founder that wants to make that acquisition. And then lest we not forget that valuations went off the charts in the last 2 years it's very likely that acquisition is going to be at a lower valuation than their previous investment rounds.
Yeah.
And I think the one bit of the jigsaw puzzle that I didn't anticipate is that you have early stage investors that aren't ready to accept lower valuations than the rounds that they potentially invested in. So that idea of a strategic investment includes another party. Whereas in bull years that we've pretty much experienced in the last 10 years, the hope is that the exit value is always going to be higher than the last investment round. So you don't have that problem. So these are some of the challenges that we're seeing in terms of kind of the market sentiment from that perspective. And so to the point of why the funding is down, late stage investment was the biggest proportion of investment to drop. In fact, according to our report, looking at both emerging venture markets, the Africa, Middle East and Southeast Asia, the only segment that saw the biggest increase in participation by number of deals were investment rounds that were less than $1 million. Because now everyone says, fine, let's not take risky bets at late stage. Why don't we focus on new founders, serial entrepreneurs, people that understand the need to be frugal with their cash? And if you're doing a $500K check or a $1 million check, your payoff is going to come in 7 to 8 years, not the next 2 years. So you have a little bit less to worry about. And you know what? Instead of giving them 12 months of runway, let's give them 18 or 24 months of runway. Weather the storm of the economic environment. Some of the best companies are built out of this typical economic environment. And then when they come out of it, then the model just kind of kicks in again. So the segment of the market that has seen growth, and in fact, valuations have remained stable, if not grown, is at seed stage or Series A. The ones that have fallen off a cliff are Series B, Series C, Series D, because there just isn't the capital. And even here in the region, the biggest challenge has been the people that have funded the late stage investments have been international investors. There was a time where we would see SoftBank and Sequoia, Tiger Global, the NEAs of this world coming in and doing ticket sizes of 25, 50 million, $100 million of investment. They're all focused on their portfolios. They're all focused on their home markets. So when that money ceases, you rely on your local ecosystem, and there aren't that many people that can do that check size. So naturally, as a result, investment drops off. Because when you're talking about record figures for the last 2 to 3 years, it's not your accelerator programs and your $1 million checks that gets you to $3 billion of investment in the ecosystem. It's your $25 million Series B, your $50 million Series C, etc., that gets to that figure. And so when it drops 50% or 45%, or here in the region, 23%, it's driven by the drop-off of late-stage investments.
So cautious optimism.
Going into 2024, I mean, I really think that, one, you'll continue to see some challenges around failures of startups, because in the absence of being able to raise funds, it's going to be a problem. Two, I think that people are going to close off the books for 2023 and start looking at 2024. And in the region, you'll still have sovereign entities that can benefit from fueling some of those entities. Early stage founders will continue to receive investment because it's going to be the best time to invest. As we always say, as I mentioned, the best founders and startups are built out of economic, and people talk about the best vintages are probably going to be 23, 24. And the second that the Fed, if they do choose to start decreasing interest rates, you will start to see that pickup of investment activity. The question becomes, is that going to be an H1? Is that going to be an H2? Or is that going to be in 2025? Whereas if you went back to 12 months ago, the world was looking at high inflation, job cuts, interest rates going up, which they did for the first 6 months of the year. And then it kind of stabilized to the end of the year. So when I say cautious optimism, they're still cautious. But is it going to be as bad as last year? The only thing I can't speak to is there an economic crisis that unleashes, that basically shocks the system? Well, and I still believe that is a potential thing that happens.
Yeah, I mean, some people still think the threat of recession is not over yet.
Correct.
You said to me in the last podcast we did that usually the region is, a couple of quarters behind what happens globally. So have we really felt the repercussions of what is happening globally to its fullest extent?
Well, that's the problem. I don't think that the global economy has really reflected. And it goes back to what I was saying. So we're still, yeah, for sure. But when you go to the end of last year, everyone's saying, yeah, sure, soft landing. We've avoided a turbulent landing. There's no hard landing. There's no recession that's happening. The cautious optimism is driven by what people are saying internationally. But the reality is, as I mentioned, first 2 weeks of this year, and already people are being spooked. You're seeing a war that's taking place in Yemen. You're seeing challenges in Ecuador. You're seeing what's happening Iran and Pakistan. So there's more volatility in the geopolitical world. There are challenges that are happening in the economic world. And lest we not forget, 2024 is going to be an election year. So what does that spring up in terms of surprises, in terms of policy, in terms of, is Biden going to end up being a lame president because he's not going to be able to actually enact things? Is he going to be focused on the campaign trail? And again, I mentioned the US because a lot of the global economies are driven by the behavior, albeit I believe that there's a shift and change specifically here in the region to align much more to what's happening in Southeast Asia as opposed to what's happening in the US and Europe, which was kind of solidified by the BRICS announcement that many of the Middle Eastern countries are now participating in building out relationships. But we shouldn't forget that there's still a war that's going on between Ukraine and Russia. You're still seeing volatility across different markets. So the cautious optimism is they have to start the year more positive than you ended the last year. Mm-hmm. The US was looking at positive signals ending last year, but it's cautious because you can't be fooled that something could still get worse. In the startup world, you have to focus on early stage investments still being strong. There is enough dry powder. You look at the amount of capital in the market, it's still a drop in the ocean compared to what's happening globally. So as a percentage of capital, there still is. But I do think when you look at our region, you are really focusing on 2 or 3 countries of potential growth where the rest are going to have to work out. Is this a game that they want to be playing in, or do they have bigger problems in the real economy that they need to be solving for?
Yeah.
And that's something that we predicted in the report. Saudi Arabia is most likely to lead not only by investment, but also by number of transactions. But interestingly, when you put that in the context of the other Southeast Asian geographies, it's still a third of the amount of capital that's being deployed in Singapore. Now, Saudi Arabia's venture space has only been 5 years old, and the one in Singapore is about 15 to 20 years old. So there's a maturity that comes to fruition. But in terms of context, there's still room for growth in the emerging market space, much more so
than in the US and
Europe. Absolutely.
By the way, I looked at it. So we're a $5 trillion economy in MENA. And I looked at the private equity numbers. So how much investment has gone into private equity in MENA? It's 14.16 billion roughly in 2023. This is PitchBook data. So 14.
Be careful what they include in that data.
Yeah, roughly. That's why I said roughly, and it's a September 2023 report. So I'm saying roughly, right? So 14 billion roughly in PE, 2 billion in VC, $5 trillion economy. So literally, it's like the amount of money that's going in VC is nothing.
I think I looked at a chart once. They were talking about
it's like less than 0.1%.
0.1%. Exactly.
We did this
2 years ago, or a year ago. I put out a chart that benchmarked it. I recently did a great webinar with Luca Bardabi, who's the GP and CEO of STV. And he was comparing Southeast Asia compared to the MENA region and Saudi Arabia, I think, deep dive. You realize that here it's close to 0.1 up to maybe 0.2%. The average in the US, I think, is 2.5 or close to 2% of capital that's being deployed.
It got me thinking, like this whole hoo-ha about the startup ecosystem, the whole thing we've been doing for the past decade. It's small.
But what's a decade? I mean, like Silicon Valley has been around since the 1940s and 50s, right?
Yeah.
So we're still at the infancy. It's something that I always say, and we're the trailblazers who have been doing this for 6-7 years. So we feel the pains and the scars of being developed. But in the grand scheme of things, take Singapore, which I went to earlier last year and had a fascinating discovery. The ecosystem in Singapore is maximum 15 years.
Singapore is how many people?
5 million.
5 million.
5 million people.
Wow.
5.2 million people. They had close to, I think, $4 billion of investment last year, which was down some 60%. So it was about 7 million the year before, right? Billion the year before. They've been around for at least, let's say for the sake of argument, 15 years. And if we talk about the celebration of entrepreneurship here in the region, we're at 10 years, right?
14.
13. So around that time. So it's 10 years, right? 10. Well, how many years does it take to exit? We say on average, based on our data, for the sake of argument, it's about 6 to 7 years, right? If you say 2013, celebration of entrepreneurship, If
2010.
Was it 10?
Yeah.
Okay, fine. So the first VCs that were being set up were in 2012, 13. Assume 6 to 7 years of exit. Where does that land you? COVID. How many exits do we see that were happening in the midst of 2020?
One.
Not many. There were, but not many.
I mean, well...
There was InstaShop, there was Kareem, I'm sure there was some 20, 30.
Yeah.
My point being, not many. So you have that. Then you have the next 2 years where everyone was fueling venture capital, and we see a record 2 years of growth. So how many exits were taking place then? There were a record number of exits, but not many exits. Now we're going through an economic
record number or not?
There was a record number relative to previous years.
Okay.
But it's not like they were astronomical in terms of exits.
But they're smaller exits.
Of course.
Yes.
But they were taking place.
Yeah.
Now we're going through an economic environment which is challenging. So in that 10-year period, we've grown. There are more VCs than we've ever seen. There are more startups that we've ever seen. There's more capital that was being deployed than we've ever seen. But it's still in its infancy. I think I pulled up the number for you 10 years ago. $180 million of investment was put into the ecosystem. We're now talking about figures of 3 billion that was done in 2022 for MENA. So the growth trajectory is aggressive and it's big, but it's still relatively nascent.
Yeah.
And it'll be interesting to have this conversation in 10 years. But to your point, yes, there hasn't been the amount of capital deployed compared to GDP or the wider economy, but it takes time for that to build up.
Why would the wider economy care about the startup ecosystem? Like, why would talent leave, I don't know, McKinsey and go into a startup or any other company?
Well, I mean, number one, it's technology companies have really facilitated kind of the wider ecosystem. And we're living in a technologically advanced world. I think the COVID period of lockdown really accelerated the understanding of why it was important. If you go to Saudi Arabia and the legislation and the laws that were changed for cash on demand, payment platforms, contactless cash platforms, and the ability to do that. People used to pay in cash. Now people are becoming a lot more confident using credit cards, if not Apple Pay, if not, I don't know how they make their transfers, but it's not using cash anymore. I don't know how many people use cash. There was a time where you didn't get things delivered to your house, you go to the supermarket.
Yes.
That got very quickly accelerated. Zoom, transfer, conversation, entertainment, Netflix, like it doesn't matter what segment, education, healthcare, sustainability, food. In the last couple of years, there's been a rapid acceleration of technology. Well, who are the people that are driving technology? Corporates have historically always been mammoth organizations, big cruisers that take time to shift. So startups basically fill the gap by trying to create, in my opinion, efficiencies. Tech startups or VC-backed tech startups create efficiencies where inefficiency exists using technology. That for me is the definition of kind of the tech startup concept. And the reason that VCs invest in them is because ultimately they believe that they can scale extremely aggressively using technology. That takes time to kind of develop. So when you talk about why people quit their jobs, they believe that that payoff of trying to solve something without manual labor, without people, without having to get production and hardware and etc., can be done effectively. Which is when we go back to who are these founders? They tend to come from an industry. They tend to come from a management mindset. The best cases in the US, they're coders themselves because they're solving that technological problem. Here it's tended to be the business side for which they outsource or in-house develop the technology. In the European or Western markets, it's the technology people that bring in the business minds to try and develop the business concepts. Why quit the job? Because the payoff could potentially, if you get it right, be astronomical.
But it's not, I think it's not just the money. I mean, look at you.
But it's also the business.
You're an entrepreneur. You've been building for now nearly a decade.
I'm not sure I'm the best example.
Look, you are creating impact. So I think it's not only the money, but
for sure,
it's a valid question. Like, why would someone wanna quit a job to enter into this? And I caveat this because I am into this ecosystem, and this whole podcast is about the ecosystem.
Well, I think one of the challenges. So let me answer it differently. I think one of the fallacies is that it's easy to do. So why do people want to do it?
Oh, because they want to be Mark Zuckerberg.
Correct.
Yeah.
But no, people want to do it because they believe fundamentally there's something that they can solve for. There's money to be made and there's impact that can be done. And yeah, you're right. Impact is some of the best drivers for innovation. But in the end, A lot of them do it because they need to have something that rewards them to be able to do that. Otherwise, they would stay in their jobs, right? Problem is that people think it can be easy to do it. And I love giving the analogy, for right or wrong, that entrepreneurship is exactly the same as football, exactly the same as tennis or any sport that you like. There is one Ronaldo, one Messi. There is one Federer, Nadal. There are, for the sake of argument, to keep it simple, football. There are Manchester United, Real Madrids. Each of them have 20 players that are part of their squad, or 30 players of their squads. Each of them have 20 teams in each of the leagues, and each of the leagues are 5 per country. There are billions of people that want to play football. But what it takes to get the Ballon d'Or and be the best player in the world, for the sake of argument, which is the decacorn, and then you have the unicorns, which are the Champions League players, and then you get into the usual $100 million exits, which are whatever it is, but everyone wants to play football. But what it takes in terms of talent, hard work, determination, not getting injured, not having challenges in the market, it's exactly the same kind of concept. And I think that's one of the problems. What is it? 90% of companies fail? That's fail. It's not even like being able to break even. It is just not an easy thing to do. So a lot of people want to do it, but what it takes to be successful doing it is completely different to wanting to quit your job and become a founder.
Why do you think we don't have more unicorns here? Is it just the factor that it's been only 10 years?
Yes, but I also think it's just not something that people should be focused on. I genuinely believe that it's somewhat of a flawed metric of success.
Okay, say more.
I think it's a very important metric for people to benchmark against because it's the ultimate goal. When you look at the US market, IPOs had become a lot more prevalent. And again, we're talking about an industry that's developed over 50, 60 years. So yes, time is very important to it. But unicorns are a status symbol. But it doesn't mean that they're good businesses. There are many unicorns on paper that have actually shut down. I always remember a friend of mine, one of my best friends, that invested in Jawbone back when we were at school.
Oh, was that the bracelet? The fitness tracking?
It was the fitness tracking, and then they made music boxes, and they did
I remember that.
etc.
Yeah.
And he was an angel investor in that company. And he did amazingly well, except he didn't exit. And a unicorn company can become a unicorn, and then it can get bust because if it doesn't keep up with the times. And there are many examples of companies, lest we not forget that right now, companies that raised at unicorn valuations in 2021 and 2022 are no longer unicorns, but they remain unicorns because that was their last investment round, but they haven't been marked down. I think we need in the region just more successful exits. Success breeds success. The more exits that we can find in the region, the more you have founders that can come on to build another startup. One of the predictions I put in the report, this year will be a year we see more serial entrepreneurs coming from the region than ever before. Either they would have exited their companies or unfortunately they would have failed. And now is the time that they decide to do something else because they still have the bug, and we're all somewhat crazy when you want to start a company to do something else. But as a metric, why don't we see more entities that are unicorns? Well, you can backward engineer a unicorn. You give a company enough money. In fact, I think STV calculated that to get a unicorn valuation, you need to receive close to $240 million of funding. And if you want to backward engineer how to get to $240 million of funding, you go through each of the investment rounds and what the average investment round, and you can get to a unicorn valuation.
Well, Saudis announced 8.6 billion roughly in funding to startups. There's 4 billion through SVC, Jada, and Sanabil, and now there's 4.6 billion, and now there's 4 billion through Aramco.
Yeah.
So I don't know how much of it has been deployed, but there's roughly around $8.6 billion.
Yeah.
So if it's how much? 240?
240.
All right. Okay. So we can do the math.
Well, I leave you to do the math on that. But my point is, in the end, what is it that's the right metrics of success? Is it employment? Sometimes employment is a flawed figure because you can employ a lot of people. It doesn't mean that you have a sustainable business. Is it revenue and percentage of GDP, the contribution of a company to the actual impact of a geography, which for me is one of the more pure, but how the people have access to the revenue that's generated. And many successful unicorn companies or successful scale companies have operations in many geographies. So which country is actually benefiting from the revenue because you're operating in so many geographies. But it's a status symbol. Now, some will argue, and I don't necessarily disagree with them, that you need to aim. And a unicorn status is a great signal to aim towards. Some may fail in getting to that pursuit. The ones that succeed are examples for others to be replicated, and they're extremely good. But I think that right now, what the region really needs, and I think the stat that I've pulled out is, if you take the total number of companies that have raised funds in the MENA region, I think there's 2,500 investments that have been done in the last 10 years. And something close to 2,200 companies that have received those investment rounds. Less than 6% of those have exited. And we don't even know whether those are good exits or M&As or whatever it is that's happening. So we're really thirst or striving for more exits to happen to provide liquidity to who? The founders who've worked extremely hard, the employees that have worked with them, the investors that have invested them at every single stage. And if that begins to happen, if we start applauding any exit and start saying the $50 million exit, the $100 million exit, the $200 million exit, there's a story. Well done. Congrats. The founding members start again. The employees say, I worked for that company. We exited. We start again. If we started to see an acceleration of those exits, then you build up to seeing more and more unicorn exits. But again, to the final point of the unicorn exits, how do you get to the unicorn valuation? You need those late stage investment rounds. Tabi, Tamara, you saw one or two other examples that were coming in the last couple of years. Or you IPO, but the market is not quite ready for IPO listings here in the region. So the answer is, are there investable companies to get to a unicorn valuation? Or is there an IPO market that makes it interesting to be able to get to that? So in the absence of that, let's just start hopefully seeing and aspiring towards companies that can get acquired, both by corporates and international players, see that come back to the ecosystem, except that we're still 5 to 10 years in the venture journey of the region, and start building that talent, experience. And we're also focusing very much on the founder side. There's also the VC side. How many VCs are we going to start seeing come with new GPs or people that have experience in previous venture entities with experience of not the 10 years of bull that we saw of record. There was a time where we were sending
everything was doing well.
We were doing press releases every single year. Record year of funding in the MENA region. Record year of funding in the MENA region. Record year of... And it was like, okay, guys, every year is a record year. Then all of a sudden it was like, it's not a record year. Oh, why? Well, and now it's not. It's even worse. Okay, as people asking questions, what's happening? But for several years, it was more and more investment that was going into the ecosystem.
No, I think just a couple of comments on what you said. I think, a $50 million exit is amazing. $50 million. I mean, it's amazing. That why not? But I think
$10 million is amazing for the founders.
$1 million is okay.
You could argue that the VC may not be happy. And
that's the problem.
The model might be flawed in that perspective.
That's the issue, right? Because the VC is giving you $5 million on a $20 million valuation
But to be fair, I don't want to say that the model's flawed. It is the model of the venture industry. So you need to know that going in.
But that's why maybe it could explain why we don't see, $100 million exits, more of them, because maybe is it in the interest of VCs to see that?
Well, I made that
because
point
that doesn't
earlier.
give their 10x returns, and it just whatever.
Very much in the case that we're seeing now, where valuations are going down, but that doesn't mean that when things were going up, we couldn't have seen more exits potentially. I don't know. I'm not an investor, and I'm only the founder of MAGNiTT, not every other company. So exits by nature are very emotive, because ultimately the founder is giving up their company. It's a journey. You end up joining another company, and there's usually a period in which there's a transition. So as much as people think it's almost much harder to create an exit than it is to do an investment round. Investment round, someone wants to give you money. Thank you very much. We need to go through due diligence, get the investment. An exit, you've got the terms, you've got the people, you've got the strategy, you've got to think about what that means for the company. You're giving up your legacy. You as the individual or the C-suite need to think about what's your role. It's usually because you're going to a bigger entity. So what's your role as a smaller part of a bigger entity? It's an extremely emotive, financial, and legal structuring challenge as part of the conversation. So it's very simplified to say we would like to see more exits. But if we can have an attractive model where people are interesting for international parties to become interested in the region, I think that's one part. I love the books that Chris Schroeder writes. I love the books that are kind of highlighting the region, the stories of the region, the opportunities of the region. If we want to see more of those exits, then people need to be bought into the opportunity of the region and the opportunity, which is why Saudi right now is becoming so popular with the opportunity, because it's got a massive market size. It's got huge potential. It's got a high purchasing power. The unit economics stack up. It's coming into huge development of infrastructure across the board. That becomes extremely appealing. When you look at other geographies in the MENA region, that story becomes a little bit harder, which is why so many tech companies are now focusing on the UAE and Saudi Arabia as the opportunity for an international acquirer and or a corporate to come and acquire you.
What do you think those Saudi funds are gonna do to the ecosystem? I mean, you have again $8.6 billion for what's been announced, and how many startups are in Saudi? I mean, what's kind of like the pipeline like, right? So
I think it's great.
Yeah, I think
it's a great stimulant to the economy.
Yeah,
I think it's a great stimulant. I think everyone is fair.
But do you think there's enough pipeline?
Well, it's a great question. I don't know. I mean, it's a question to understand what the founder quality is like. I mean, that's why.
Because I think would you rather have, a mega deal, $300 million into one company, or should this money go
I think it's both. I've always said that if we go to the concept of the football again, but it's a pyramid scheme. Before you become a Ronaldo, you have to go up through each of the kind of different levels to get there. And so you need to build the bottom of the infrastructure. Again, when you look at super mature markets, people are leaving university, but they're the engineers that are part of the entrepreneurship and coding school that come up with a concept, try it at home, get some traction, quit, and etc. Hence, there's always a push, specifically here in the UAE and Saudi, across the GCC, even in Egypt or the rest of the Levant, on education, coding. How can you bring talent to understand the basics? Because we're talking about tech companies. There's still the basic tech part of the business model. So in Saudi, again, venture is about 5 years old. SVC, the report that we published, they're celebrating in a week or so the 5-year anniversary of the SVC formation.
SVC is Saudi Venture Capital.
Yeah. And the report that we've been publishing with them, it's 5 years old. I mean, the amount of capital in Saudi 5 years ago, we just said that MENA 10 years ago, it was 180 million. In Saudi, 5 years ago, it was less or close to $100 million of investment, and they just recorded 1.4 billion in 5 years. So as a concept, venture capital is still relatively nascent, and yet they've seen this huge trajectory of growth in the kingdom. But to keep up with that, there's two ways of doing it. Importing companies, because they see the opportunity of growth, for which you hire talent. Lest we not forget that every time you're bringing a company from abroad, you're having to hire people locally. Those people get educated on the mindset. I think something that people don't quite always realize is that when you're talking about tech talent, there's the skills side of it. So coding, marketing, business development, strategy. But there's also the mentality.
Of course.
To answer your question, is there enough? I don't have an answer to that. There's plenty of programs for accelerators. There's plenty of programs for incubators, plenty of people trying to start, but it's the football model. Everyone wants to be a founder and entrepreneur, but does that mean you have the skill sets? Or what I advocate for always, join. I wish government entities would push more for entrepreneurship, like supporting students join, pay for the salaries to join a startup. Yeah. It's almost an apprenticeship. That if you give a MAGNiTT X amount to pay a salary for 5 interns that can join on a 3-month, 6-month rotation, but they get the experience to see what it really is like to work for a funded tech company. And then they go and get 2-3 years of corporate experience and then decide to do something themselves. They've had real life experience doing it rather than them trying to do it themselves and not have the skill set to be able to do that. So I do think that there's the soft entrepreneurial mindset and working for a startup, which is very different to working in a corporate. And then there's the necessary, I mean, I always told one of the founders, Kareem, told me there's a triangle. There's the experience, there's the skill set, and then there's the hustle and the mindset. You need to have at least 2 of those things. And when you're starting your career, you may not have the experience, but you need to get the hustle. And if you can't have that, get the experience in understanding what that is while developing your skills. And then the experience will build up with that.
Yeah, fully agree. I think that's a solution. Instead of advocating for university students to start companies, I think the best thing for them would be to join startups.
But not even that. I advocate for that guy from Google. Let him go and join as a management role before starting a company. Yeah, there's many people that come and say, okay,
Google is great. I mean, you're talking, sometimes people are like,
I'm picking on Google. I'm just saying, like large corporates put Nestle.
Look at the GCC. A lot of people are employed in government. So try to move someone from government to a startup.
Correct. And in that case, go and find a role within the startup. Spend 1 or 2 years and then go and do something yourself. So to answer your question, there's a lot of capital. They need to go to good companies. You either import them from abroad or build them up, bottom up. There's only so many that they have, and they need skill set, experience. And along the way, things are going to work. Some are not going to work, but it'll develop with time.
You talked about Southeast Asia, right? So you said that it's 3 times the size of Saudi, for example, in terms of investment. Are there other things that you've noticed that you think our ecosystem can learn from that ecosystem?
Yeah, I mean, ultimately, it's a great leading. From a sectorial perspective, you always see that the first segments that get disrupted are transport and logistics and e-commerce. And then you go into fintech.
It's like the basic digital transformation layer.
Digital transformation.
Yeah.
If you go to Singapore, and like I went, if you speak to any government entity, the majority of the conversations are around deep tech. So the next evolution away from fintech is into other areas. Now, the question is, there's no real definition for deep tech, and everyone has a different kind of concept towards that. But you're talking about real technological solutions.
Other than give me my groceries in 15 minutes.
Correct. So there's something that can be learned around the educational systems, the university systems, the investment and research and development. There was a whole conversation. I was on a podcast with Pepsi around COP28. And one of the questions that they were asking is, why do we not see more sustainability investment?
Yeah.
Why do we not see more investment in food security?
Yeah.
Well, the question is a bit flawed because you've got to flip it on its head. And I mentioned this earlier in the podcast, sorry. The VC model is built on exits. So if you want exits, you need to build a company for exit, either IPO, and we've already said that's somewhat challenging, or for an acquirer. So when you are going into a super capital intensive technology company that focuses on sustainability, solar power, things that are extremely important, but require a huge amount of capital, and yet you do not have a clear path to exit, VCs who are LPGPs that are not specialized, and let's be clear, in the region, there aren't that many specialized VCs. Everyone's still relatively generalist by sector. Means that the risk appetite, not having made the returns yet in some cases, is in a risk-off mindset. And therefore, you levitate and migrate towards industries that are more traditional, transport and logistics, e-commerce. You have an acquirer, you know of a company, financial services. Is there a payment gateway platform internationally that might want to move to the region and have an acquisition? So that's why you tend to see more of that. The more exits that you get and the higher the risk appetite, the more VC funds that create more second funds and third funds and have higher risk appetite to invest in particular segments, either by stage and or by industry, the more you start seeing further development.
So let's wrap up with some predictions. You had some predictions in the report.
Yeah. Well, we made 5 predictions in the report. I think the first one is relatively simple, that excluding mega deals, which are those $100 million investments, because they somewhat skew and you can't predict who's going to be able to achieve that, you're going to have a very flat year of venture investment this year. Again,
even with the Saudi money, you think so?
That's what I mean, because the Saudi money influences the mega deal investment side. But I think that the underlying part of the ecosystem will just see kind of a flat
So you don't
result.
see it filtering into the
I do, but it'll compensate for many countries that won't be seeing investment.
Oh,
so
right.
So I'm talking about aggregate level. So my predictions are at an aggregate level. So at an aggregate level, from that perspective, excluding some mega deals that may or may not happen, the underlying less than $100 million investments are going to remain very flat, very much in line with what's happening. If you go to, you mentioned CB Insights, if you go to global figures or regional figures, it's literally up a quarter, down a quarter, up a quarter, down a quarter. And I think that's what we're going to experience going into this year.
Okay.
The second one, I think that CVCs have a bigger role to play.
Corporate venture capital
venture
firms.
capital here in the region. I think now more than ever, the interest of large corporates to get involved in tech, with valuations coming down, with many of these professionals in the venture capital space joining corporates. We've seen the likes of Ian Ventures here in the region, in the UAE, becoming the most active player in the UAE by capital deployed, sixth in terms of transactions. STV in Saudi Arabia, Shalhoub, MAF, you've had historically as being active in the venture space. And again, you can characterize that as also family offices that are kind of in the corporate space that are off balance sheet investments from corporates is going to become a bigger player as international players still take time to come and invest in the region. And in the absence of that, corporates will either invest and or acquire to digitalize their propositions. It's fascinating, separate conversation for another podcast. But when you look at the private equity and the private capital world, the definitional differences between what venture is versus private equity. But ultimately, any entity that's investing in a tech company that doesn't exchange for a minority shareholding is somewhat the definition of where venture capital lies. And so it can be a VC, it can be CVC, it can be an individual, it can be accelerator programs, it can be family offices. But it's that exchange of investment in exchange of equity.
So you're saying in addition to them investing through their family office, you see them sort of formalizing those into
through the corporate so it could be the corporate
VCs.
entity that looks to invest. Yes.
Okay.
So like in Saudi, you have SMB, which have a venture arm. You have Riyadh Bank that have a venture arm, Al Jazeera Capital. So there are entities that are beginning to play in this space. And we said that the prediction is that we'll get close to 20% of all institutions that invest will come from corporate and or corporate venture capital in the year. Currently, it's about 13%. So I think that will become an interesting prediction for the year. Third one, Saudi Arabia for the MENA region will now not only be the most active by total capital, but also by the total number of transactions. You see a lot of accelerator programs that are being developed, a lot of push from the government at each level. So we mentioned the sovereign entities, but they're supporting at late stage funding, the middle investment rounds, the early accelerator programs, incubators. So I expect that will continue to trickle through.
Probably all of or most of the VC funds in the region have Saudi money. Have Saudi as
to a certain extent as an LP.
Yeah.
But then in the end, they also have to end up investing probably in Saudi Arabia.
Yeah.
So to a certain extent, that's part of the wider proposition. I mentioned the point about serial entrepreneurs. I really think that this will be the year that we start seeing the rise of the serial entrepreneur.
And these don't necessarily need to be ex-founders. They could be people working in
potentially.
successful
I was
startups.
referring more to the founders, but yes, it could be the C-suites. My prediction is based on the following. Exits that saw a record amount of exits in 2022, not 23, usually have a lock-in for exit for about 12 to 18 months, not 2 years, are likely to be in that grace period of where they look to start up again. And investors like to invest in serial entrepreneurs. And those that have had unfortunate circumstances where they've shut down over the last 12 to 18 months are likely to be in a period where they look to raise again. So I think that's another kind of area that will be interesting to kind of track moving forwards. And the final one is I do think that this will be the year of exits again. I made that prediction last year, but I do think that we're slowly seeing valuations settle. International markets are going to start looking at opportunities for growth again. The thing that I think will be extremely interesting to track is secondaries. Not a lot of spotlight has been put on secondaries.
So secondaries is
basically being able to sell your shareholding as an employee, founder, or potentially an investor without there being
selling the whole company,
another investment round or an exit. You can sell your shareholdings to third parties. And number one, the reason for that is because people are looking to potentially sell out and investors are looking to buy in. And the second is that there are more platforms that are being created to help facilitate that. And government is also trying to see, instead of IPOs and trying to hope for the full IPO, can we facilitate private access to secondary exits in companies? And I think that's something that'll be interesting to look for. And I do think that probably in Saudi, you will see the listing of some companies this year, which will be an interesting trend to kind of develop.
Yeah, I think this is definitely going to be something to watch. I know already a couple of companies are working on listing in Saudi. So we've had one list, which was Jahez, which is doing well. I mean, the stock did go down, but it's still a pretty valuable company. So I think it'll be interesting to watch watch that space. But when you talk about exits, you say the year of exits, we're not talking again like big exits. You're talking
I'm just talking
pre-Series B,
yeah.
something like that, right? So we're talking
I just think there'll be some
like,
element of consolidation.
Yeah, okay.
That like we've gone through a very challenging period for the last year. Venture funding is hard to come by. Many companies have cleaned up their books and tidied up their stories. International appetite may begin to return. I do go back to the cautious optimism. I mean, this is cautious optimism predictions on the hope that potentially interest rates, if they are to decline, every one of those predictions has a much higher conviction once interest rates start going down. If we face some kind of economic catastrophe or crisis that we saw in 2008, you can literally throw every one of those out the window and maybe one or two of them come to fruition. But ultimately, if the year pans out as many are predicting or stating that the first 6 months are likely to be challenging, interest rates begin to come down, soft landing happens, inflation's under control, investment starts returning in Q3 and Q4, many of those predictions are likely to come to fruition.
Yeah. I feel somewhat hopeful also for 2024. I think there's a decent amount of money out there. I think there's a lot of, as you said, second-time founders or people that have had experience in these high kind of growth startups that are coming into the market. There's a push on the government side, at least in Saudi, for example, we see it now to grow that ecosystem. So I think it's interesting times.
Yeah, well, hopefully.
You just need crazy people that would go out and do the hard
There's plenty
thing.
of them who are doing it already. And that's one thing that's clear. There's plenty of them, not crazy people, plenty of entrepreneurs who are doing this already. Now is the time to invest. I'm a big believer that if it's the right kind of company and the right model, if you invest now, your payoff comes when things return. But if you let them all die, and again, some companies will have to, it does make sense because they were just not the right models.
Did you track that this year, by the way?
We did. We're doing an update now.
Last time we spoke on the podcast.
Yeah, I think it was 18% in a year that had shut down. We're doing a final year update at the moment to kind of track because it's kind of hard to.
Okay, so you don't have the number yet.
Not for now. But I think that companies that have got to unit economic profitability or at least being able to be stable, if invested in now, have cut some challenges that they were facing, have a much clearer business model, and are likely to be able to accelerate going into next year. And having gone through the pain of last year, people are a lot more conscious about what that ROI story of getting the bang for buck to be able to kind of build out their proposition.
Cool. Thank you so much.
Thank you. Thank you for having me.
Thank you so much for tuning into this episode of Conversations with Loulou with Philip Bahoshy. I hope you found it insightful. As usual, check out conversationswithloulou.com to listen to all the other episodes. Don't forget to subscribe wherever you listen to this podcast or wherever you watch it. And do leave us a rating and a review. It really helps in getting the show discovered. Don't forget to share this episode with whoever, your colleagues, friends, family, whoever may benefit from this content as well. And lastly, if you can go to the show's description and click on the podcast listener survey and spend a few minutes to fill out the survey, it would really help me and get to know you a little bit better. Thank you so much and see you in a few weeks.